Welcome to our presentation on Amazon's investment project. My name is Angela, and today my group members Lance, Eric, Ryan, and Karen are here to propose various growth opportunities for Amazon through our management accounting concepts. Table of contents. Throughout our presentation, we will be discussing key topics for Amazon's investment project, including the SWOT analysis, data analytics, as well as two major accounting tools and their environmental impacts. Executive summary. Amazon is a globally recognized corporation specializing in e-commerce, cloud computing, digital streaming, and the development of AI. To support Amazon's global operations, we are proposing the construction of an onshore wind farm compared to external purchasing. Our capital budgeting analysis reveals that this project is strongly positive with an NPV of $1.3 million, making it a sound investment. Our second suggestion through our CVP analysis shows that Amazon should shift to using electric delivery vehicles to reduce operating costs. Both suggestions provide environmental benefits, yet are both financially reasonable.
In 1 decade, Amazon has transformed from an online bookstore into a $638 billion revenue powerhouse, growing from $89 billion in 2014 at an impressive 22% average annual rate. So let's examine their strategic position through a SWOT analysis. For their strengths, Amazon dominates global e-commerce through brand recognition, industry standard logistics, and diversified revenue streams across AWS cloud, advertising, and third-party marketplace services, creating stability despite market fluctuations. However, their weaknesses include massive fulfillment and data centers facing high operating costs that squeeze margins, while dependence on external utilities limits control over energy pricing. However, there are opportunities. Significant potential exists in renewable energy investment, particularly wind farms, which could reduce long-term costs while boosting their ESG leadership. But being wary of threats, Amazon faces rising energy prices, aggressive competition from Walmart to Temu, and cloud rivals like Microsoft and Google who are also pursuing sustainability. Now, looking at their revenue evolution, the story is one of strategic diversification. While online stores grew from $68 billion to $247 billion, their revenue mix transformed dramatically. In 2014, online stores represented 77% of revenue. By 2024, that dropped to just 39%. Meanwhile, high-margin services exploded. Third-party revenue grew from $12 billion to $157 billion. AWS expanded from $5 billion to $108 billion, and advertising emerged from $0 to $56 billion. Geographically, North America remains dominant at 61% of 2024's revenue, with international at 22% and AWS comprising 17%. The strategic takeaway? Well, Amazon successfully transformed from a pure e-commerce player into a diversified technological platform. Their growth in high-margin services like advertising and AWS positions them for continued strength, while their core retail business provides stable foundation. In conclusion, Amazon's revenue diversification and sustained growth demonstrate a company well-positioned for future success.
Now we're moving on to our first management accounting tool, which is capital budgeting, where for this part of the project, we looked at whether if Amazon should build a 210 megawatt wind project to generate its own electricity, or if they should continue outsourcing it. And to evaluate that financial side of the decision, we used a discounted cash flow model focusing on net present value. Now, the question that we're trying to answer here is if Amazon should invest $294 million to build its own 210 megawatt wind farm, or should it just continue purchasing renewable energy externally through purchase price agreements at $60 per megawatt hour. Right now, Amazon relies heavily on long-term PPAs to meet both its sustainability goals and its operational energy needs, but PPA prices have been rising, and relying on external suppliers creates long-term price and supply uncertainty. Building internally could reduce those long-term energy costs, improve energy security, and support Amazon's net zero goals. So the decision comes down to whether the long-term benefits like cost savings, tax impacts, and salvage value outweigh the upfront investment. That's why capital budgeting is the right tool here. So to build a DCF, we first defined all other major assumptions based on industry data and Amazon's financials, where the wind farm capacity is 210 megawatts, which produces about 662,000 megawatt hours per year using a 36% capacity factor. The total capex is $294 million, and our operating and maintenance cost is $12.68 per megawatt hour. For the buy scenario, we would assume that Amazon avoids paying $60 per megawatt hour, and that's the PPA price from the University of Michigan's energy data. Construction takes 2 years from 2026 to 2027, and operations begin in 2028, where we also don't assume any changes to net working capital since this is an internal generation project. And finally, we applied a salvage value of $3.3 million in the last year to reflect the remaining economic life of the asset. So to discount the cash flows, we needed to calculate Amazon's weighted average cost of capital, and using Amazon's annual report plus market data like the risk-free rate and beta, we arrived at a weighted average cost of capital of 6.99%. And this rate incorporates Amazon's capital structure, the cost of debt after tax, and a conservative equity risk premium. It represents the minimum return Amazon needs to earn for this project to be worthwhile. Here's the full discounted cash flow model, where we can see that we have the construction outflows, which total of $294 million, and starting in 2028, the project can then begin generating annual savings. These savings come from avoiding PPA costs and only paying operating and maintenance costs, which gives us about a $31.3 million per year in net benefit. In the final year of the analysis, we then add the salvage value on top of the operating savings. After discounting all of these cash flows at Amazon's weighted average cost of capital, we would then get our net present value. And again, here's a quick summary of the discounted inputs that we used. Again, our discount rate is 6.99%, which is based on Amazon's actual capital structure and market returns. These inputs ensure that our NPV reflects Amazon's real cost of capital. So with using a 6.99% discount rate, the wind project generates a positive NPV of about $1.3 million. That means the project creates value for Amazon even after accounting for the full construction cost, the ongoing operating costs, and discounting everything back to today. So financially, the project should be accepted. Beyond the numbers, there are important management implications to consider. The project is financially viable, but it also reduces Amazon's dependence on external PPAs and gives them a stable internal source of renewable energy. It supports Amazon's climate pledge strategy and strengthens their ESG profile. And because PPA prices have been volatile, building internally also reduces Amazon's exposure to long-term energy price risk. Overall, it's a financially positive sustainability investment with strong strategic benefits.
Moving forward to our next section, I'll now be walking through our second management accounting tool, relevant costing and CVP. We will use these tools to evaluate whether Amazon should switch from diesel delivery vans to electric vans. Now let's start with the issue driving this analysis. Now the key question we need to answer is whether Amazon should replace its fleet of diesel Sprinter vans with electric vans given major differences in fuel, maintenance, carbon costs, and required charging infrastructure. Relevant costing will let us compare only the costs that change between the two alternatives, and CVP analysis tells us how many deliveries are needed to break even. Now let's look at which costs actually matter. When comparing our two options, we exclude costs that won't change, like driver wages, insurance, and overhead. The relevant costs are fuel, maintenance, electricity for EVs, carbon emissions, and charging infrastructure. Now these are the differences that impact Amazon's next decision. Moving forward, we can now compare the costs per delivery. Now our analysis showed that diesel delivery costs are about 17 cents per package, while EV delivery costs are about 7 cents per package. That means that EVs are roughly 60% cheaper per delivery. This cost advantage is mainly due to cheaper energy and lower maintenance. With that in mind, the next step is understanding the fixed cost of switching. Considering a scenario where Amazon has to replace 20 vans, the company must consider EV purchase costs, resale of old vans, and charging infrastructure. This results in about $500,000 in net fixed costs. The savings per delivery, our contribution margin, is 10 cents. We use these numbers to calculate the break-even point. Now dividing the $500,000 in net fixed costs by the 10-cent contribution margin gives us a break-even point of about 4.78 million deliveries. With 20 vans completing about 1 million deliveries per year, Amazon breaks even in roughly 4.8 years, which fits well within a normal fleet replacement cycle. Now, since Amazon already operates a large and growing EV fleet, this analysis reinforces that continuing to replace the remaining diesel vans is financially sensible. The lower cost per delivery, reduced maintenance, and elimination of diesel emissions all create long-term savings that justify completing the shift to electric vehicles. Strategically, switching to EVs cuts delivery costs by more than half, reduces diesel emissions, and pays back within 5 years. This supports Amazon's long-term goals to lower carbon emissions and to move toward cleaner last-mile delivery. Overall, both management accounting tools support Amazon's sustainability strategy. The DCF shows the wind project delivers positive financial value, and the CVP analysis shows that EVs save costs and break even in under 5 years. Together, these tools highlight how Amazon can transition towards renewable energy and zero-emission delivery.
Looking at our investment plan, we have significantly reduced carbon emission through using wind energy to power fulfillment centers, delivery hubs, and data centers to reduce the company's reliance on fuel-based electricity. This leads to lower greenhouse gas emission and reduces corporate carbon footprints. There is also a long-term reduction in Scoop 2 emission from originally purchasing electricity to producing it with our wind farms. Compared to natural gas and diesel, wind power reduces the harmful aspect of the environment as it does not produce air pollution or water contamination. Overall, this has helped to strengthen the company's reputation and set an example as industry standards. Therefore, being a major lead in the industry, it motivates other companies to follow their strategies in building a better community. It also helps to create a better brand image as it increases public trust and positions the company as a leader in sustainable innovation. In conclusion, since we have a positive NPV in this project, we should dedicate investment to this proposed solution. Upon review of the financial and non-financial consideration, this project has demonstrated a positive effect to the long-term growth of the company as it improves ESG and the overall sustainability environment. In terms of Amazon's short-term goals on this investment, it would be recovering from the initial investment. For the long term, the project increases overall efficiencies while reducing costs. Due to climate change and restriction on non-renewable energy posed by the government in the future, Amazon is preparing to be a leader in this retail industry.